Welcome to Markets Now. I'm Michelle Rook along with Kent Beadle with Paradigm Futures. Lower in the livestock, but sharply higher in the grains. We had gap higher openings in a lot of the complex, Kent. And of course, a lot of this has to do with weather, but also this big drop in crop ratings kind of came as a surprise, especially in states like Iowa and Illinois.
Yeah, for sure. The trade was looking for a lower crop condition rating, but not to the magnitude that we had. I think we were looking for maybe 3 percentage points lower in corn, and we got 5 or 6, and 5 lower in beans. And Iowa particularly was a bit of a surprise because there was a very nice system that did come through Iowa this past weekend. I know growers
Right.
around the Des Moines area, Ames, Perry, places like that, that had very good rainfall, and a lot of growers were quite pleased and quite anxious, frankly, to sell this rally because of the improving attitudes that they have about their crops.
So this market is trying to figure out how much yield we're losing, right?
Correct. Absolutely. And so you have to think about, what does the USDA do in a July report? Well, first of all, it doesn't have any objective survey work that's done. So they won't be counting plant populations. They will be looking at their published weather model. And one of the components of that is June temperatures and precipitation. They're also going to look at satellite imagery and the VHI data, i.e. the greenness data. They'll be looking at that in comparison to previous years to see if that tells us anything. And then, of course, they will have a producer survey as well. And the combination of all of those things will lead to a yield estimate here in July, which the trade is going to anticipate is going to be down. I would suspect 2 to 3 bushels an acre, somewhere in that 178 type range.
So then what happens with the acreage figure at the end of the month? Will acreage go
Oh,
down and add into that fuel as well or not?
well, that's correct. We are, in addition to trying to understand where the yield is going to be, we are going to have a new data point, and that is actual planted acreage based on the survey work that they've done. Um, our sources are telling us that where we expected to have some prevent plant up in North Dakota, we probably had less than was anticipated. We are aware that a number of growers continued to plant beyond the insurance date into early June in that neck of the woods. We're also listening to seed dealers, and if we were to guess, we would say that the corn acres will at least remain steady and potentially might tick up a little bit at the expense of soybeans. Now, I have heard some analysts suggest that up in North Dakota, there may have been some beans switched in for corn. I'm not necessarily hearing that from my clients and my sources, but I know that's an expectation that some people have.
Let's talk about technicals as well. We got November beans above $13.50, pretty good resistance. We got December corn above $6. So if we close above those levels, do we take the next leg up here?
Yeah, 1385-ish on the soybeans, and then up toward the January highs at about 14.15 a bushel would be next stops in beans. In corn, it's amazing how quickly we were able to get into that get above the February insurance price. Yesterday we exceeded the January highs, or today we did at 611. And now you're looking at somewhere around 635 is the next stop for corn.
And wheat, is it just following corn and soybeans, or are we also working in those lower spring wheat crop ratings there?
Yeah, a couple of things there. Certainly lower spring wheat crop ratings. I think that was a surprise as well. Keep in mind there has been some rainfall in North Dakota, and to see things go down as quickly as they did. One of the keys there is in South Dakota, where your heading percentages took a big jump, and they're actually about 17 points ahead of average. With a crop heading out that early, that suggests that some of those acres are heading out in the midst of moisture stress, and that yield potential is maybe down a little bit in South Dakota. And then the other thing is harvest progress in the southern plains for the hard red winter wheat crop, and we're falling behind a little bit because of excess rainfall that of course that they're getting in the southwest part of the country that you're not getting in the Midwest, and that's keeping the combines parked and starting to fall behind. Also, maybe a little bit of concern about quality with the excess rainfall at this point in time.
I'm also going to throw heat in there because I think that's the other reason we saw that big drop in that spring wheat rating. It has just
Yeah,
been pretty brutal. 90s for this time of year is
yeah,
unusual. The
yeah,
only place where we're seeing a negative this morning is soybean oil. Soybean
right.
meal is going the opposite direction. Those spreads being unwound, and that's all about this EPA renewable fuel standard proposal or final draft that was let out, right?
Yeah, we didn't see the actual draft when it was potentially leaked last night, but we did note that in 2024 and in 2025, the actual mandated production levels were lower than the previous releases that were made public for public comment. And if you remember, those estimates were well below what the trade was looking for. Now, what's interesting about that is that, some of the expected increase in renewable diesel production is been driven not by EPA mandates, but by state mandates along the West Coast. And I'm not sure that these EPA mandates, have any superseding ability to keep the grind lower if you have those mandates at a state level. But the market is trading it as if this is somehow going to be negative for soybean crush and for soybean oil-based renewable diesel production. And with a lower potential soybean crush, you're getting a huge response in the meal in the opposite direction. It's a very positive response. Meal up now over $21 a ton this morning. Keeping in mind that if we have a little bit lower soybean grind combined with the lower crop that we still know is in Argentina, it's going to tighten up the meal situation in the world.
Yeah, and the farm groups are already saying that they're disappointed about that biofuels mandate that was released by
Yes.
EPA this morning. So cattle market, we took out some support yesterday. We had some lower cash trade. How much lower do you think will go here? How much more do we need to correct?
Well, obviously you've had cash trading at a fairly sizable premium to the futures. What's happening in the futures is more speculative liquidation of positions that they were in, expecting that the cash or the futures to converge to the cash with the futures moving higher. And instead, what they're being forced to do is liquidate that position. We're probably already getting close to a fundamental price where we're going to likely start to find end user support. But if we move down another $2 or $3, I don't think that would be surprising just on a speculative liquidation alone.
And hogs are sitting back here as well today. Is that profit taking, or is that, a realization here that higher corn and soybean meal are going to mean some tighter margins, or what?
Well, yeah, and margins are not great anyway.
No, they aren't.
And this absolutely hurts them further. We have been driven higher recently by a long-awaited surge in summer cash prices, and my sources in the industry are telling me that those high prices are likely, if they haven't peaked, they're going to peak here soon. And as this is a futures market, we're probably already starting to sense that, and I do think that we've probably run our hogs through most of its upward course here for the summer.
All right. Thanks for joining us, Beadle with Paradigm Futures. That is Markets Now.